So the dynamics are starting to slightly shift, which means that, the exaggerated price that we could get in maybe Jan, February, March, in the last couple of months, we're seeing that buyers are becoming more discerning, and it's not as easy to get those exaggerated premiums. So do bear that in mind. If you've got properties that you're looking at selling or thinking about selling, it will be a realistic market high. But that said, the market is still very good. And also we're seeing that where exaggerated or very high premiums have gone through on offer, we are seeing banks come back and down value these prices. So it's all well and good us agencies valuing at one level, and then when the bank comes into the survey, if the investor or the buyer is buying with a mortgage, and then they down value it by a percent or two or X number of thousands. So that is the problem, because then the buyers are coming back to renegotiate based on the fact that the agreed price the bank will not value to the same level, because obviously banks are a lot more conservative than agents, and that's the way it always goes. So please do bear that in mind. Buyers are negotiating harder because they are realizing that is the case, even though it's still a property owner's market. Just a few little statistics to share with you. According to the Land Registry Office, as of the 13th of June this month, the average terrace property in Luton has been selling for around 260,000, and the average semi-detached property in Luton has been selling for about 310,000. And apparently semi-detached properties are the most popular sale at the moment in the last half year. Overall, prices are up about 3% in the last 12 months in Luton specifically, and prices are up 13% in comparison to 2019, where property prices were also at another peak. So the market is rising, the market is good, despite the fact, like I said, the exaggerated premiums are a little bit more conservative now. In my personal opinion, I think that for the rest of the year, because it's a question that we are asked all the time as agents, what's going to happen to the property market? Will properties keep rising? Will they fall? I think that we will see the adjustment in terms of the exaggerated calls stay like this for a while. I don't think we're going to see prices literally plummet, but I think definitely we're going to have it at a sensible valuation high. So that's where I see the market going, certainly as we move towards the end of the year. I don't see any trends or any statistics for the market to fall out, but I do think that it will simmer down and we will have realistic valuations against property values. In terms of tenant demand, because obviously we are investors here or potential investors here, tenant demand in the Luton market is still crazy high. Again, it's driven by not enough rental properties coming available to meet the demand. So we're seeing that from the tenant's point of view, literally we put landlord properties on the market to rent, and they're renting literally in days, maybe a week or so. And the rents that we're achieving at the moment in Luton are phenomenally high. I mean, I have not seen rents this high. I've been in the business since 2007. And for me, this is the highest I've seen rents. And it's a little bit concerning for me, because I look at things like the affordability, because it's one thing to get a really good high rent for your property, which is what we want as an investor, but it's another thing for tenants to be able to afford to meet that rent commitment, plus bills, plus the rising cost of living. So I think it's something that we have to be very cautious of. I mean, we're renting now, for example, 2 beds in the region of 950, 975, sometimes, slightly newer 2 beds are reaching almost £1,000 per calendar month. And those are apartments and not houses in some cases. So the rents are really high. But with that, as a landlord, you have to bring the quality. You cannot expect to charge tenants today a premium rent for a less than average property. Your property has to be presented correctly. It has to be clean, it has to be tidy, it has to be fairly modern. Whatever type of heating system you have, it has to be efficient, especially today with the cost of utilities that has gone through the roof. So if, as a landlord, you cannot expect to grab the rental premium, but present a less than premium type property, it's just not going to happen. Your tenants either will refuse to pay, or you will seriously end up in an issue there. So yes, you can get very good rents for your property, but you've also got to bring a very good property to the tenant market. Tenants are still looking for space. We're still seeing the whole lockdown pandemic driving tenants towards working more from home. Lots more hybrid work is going on with big companies, small companies. So we are seeing tenants looking for more space, ideally looking for properties with some sort of garden or balcony space because they are working from home more. So one of my favorite footprints that I always talk about from an investment point of view are the 2 up, 2 down type of houses in Luton, where you're buying properties that have 2 bedrooms and 2 reception rooms. That's a fantastic footprint that rents all day long in Luton because you're open to young professionals, couples, small families, even singles who are on high earnings, don't mind paying for a 2-bed for the extra living space. That always tends to be a rental footprint that works really, really well, especially now that people are working from home more and they are looking for that 2nd bedroom as an office or the 2nd reception room as an office if they've got a family. If you can buy into the 2 up type of property, you will have an array of different types of tenants available to you, which will mean that your property will rent quickly and obviously for a very good premium price. So that tends to be my favorite takeaway as a landlord investment type of profile property. And that's literally all I really wanted to say in terms of a mini market update. From a yield point of view, I would say now in Luton, if your properties are yielding in terms of a return on average about 4.5% or more, then you're doing well as an investor. Going back a few years ago, a good yield in Luton was probably between 5 to 6%. We have seen that yield come down slightly because of the rise in property prices to invest in the first place. So obviously as an investor, where you're paying a little bit more, or a lot more, I should say, for these properties, even though rents are high, we've seen the yield slightly adjust. But I think a 4.5% minimum yield, if you can achieve that on your investment, you're still doing amazing in comparison to interest rates and other investment opportunities out there. So that's kind of where the Luton market is trending at the moment in terms of property yields. And a very, like I said, a very brief mini market update from me. So without further ado, I'm going to hand over to our keynote speaker for the evening. But before I do that, I'm just going to introduce Ellie to yourself so you have a little bit of a background about Ellie. If you just bear with one moment, I'm going to read it from her profile so that I read out the accurate information, because it's important for you to know Ellie's background and why she's here sitting in front of us tonight to tell us about property finance. So I'd like to introduce Ellie Broadhurst. She's from Bayer Financial. Ellie works with property investors throughout their journey, from clients starting on their first project through to experienced portfolio landlords and developers. Ellie can offer straightforward lending or more bespoke solutions. At their firm, they use their expertise and their relationships with specialist lenders to take a creative approach to help you achieve your finance goal. Ellie has been working in the finance industry for over 17 years, starting off in retail banking, as a mortgage broker, and she's been dealing with commercial mortgages now for over 6 years. So Ellie is well qualified to sit in front of us tonight to give us lots of information, lots of hints and tips as to how we can really look to scale and grow our property portfolios with some creative property finance options and techniques. So Ellie, thank you for tonight, and over to you.
Thank you, Vanessa, for that lovely introduction even. And good evening, everyone. Thank you for logging on and to listen to me this evening. So as Vanessa said, I am going to talk to you today about how to grow your property portfolio. So I've got a presentation that I'll share, but just before I do, I just wanted to let you know really why it was that I want to talk about this and sort of who it's relevant to, really. So as Vanessa mentioned, we work with people right from their first property all the way through to building a large portfolio. And where we sit within the market is looking at kind of specialist lending, and that's what I really wanted to talk to you about today, because I think that some things that perhaps aren't known about quite so much within this market, and it's giving you tools to be able to grow your portfolio with perhaps things that you've not thought about before, or need to know a little bit more information about. So let me share my screen with you all. So this is me. So today we are talking about scaling up your property portfolio. So I'll just give you a bit of a rundown on what we are going to be talking about this evening, and we'll go into a bit more depth on each of these things. So the benefits of bridging finance, the difference between bridging and standard mortgages. We'll be talking about using JVs, so joint ventures, refinancing your portfolio, looking at mortgages in your personal name versus a limited company. And then finally looking at HMOs and what we call multi-unit freehold blocks, or blocks of flats to you or an I. So we'll start with bridging. Now this is something I think people talk to me about all the time, because bridging has sort of historically not had a great reputation. I think people sort of think about it as being quite expensive, something that you could get charged huge amounts of money for if it doesn't go to plan. And historically, there were huge numbers of bridging lenders that didn't really treat customers very well, and charged what they like, and they weren't regulated in the same way as they are now, and all those sorts of things. So it does have a bit of a bad reputation, but you'll be pleased to know that things have changed a lot recently, the last couple of years. Now, all I would say is just be really careful about the lender that you use. Obviously, you use us, then we would make sure that we're using a reputable lender. But if you choose to use a different broker or go direct to a lender, just be really careful about the terms and conditions. Do your research and do your due diligence, and just make sure how they treat people when it doesn't go to plan. Really, that's what you want to know. But why would you use bridging finance? So if you're looking at growing your portfolio, looking to buy property, there are huge numbers of properties out there that are not currently habitable or lettable. So by habitable, I mean they haven't got a kitchen or a bathroom, and you will struggle to get a standard mortgage on those types of properties. Lettable, if you haven't got the correct EPC rating, or just the property's not in a great condition, maybe just the floor coverings aren't correct, or it's just not in great condition. You probably aren't going to be able to get a mortgage on that property, but by using bridging finance, it enables you to look at all those types of properties that come to the market, and you can still buy them. You've still got access to those properties. So it really does open up the types of properties that you're looking for as a landlord. One big advantage of that is that you've got much less competition when you're looking for these types of properties. So the majority of people that are looking to buy properties to live in themselves want something that they can move into. They might be happy to redecorate it, whatever, but they don't really want to get into changing kitchens and bathrooms and things on the whole. So if you are looking at these types of properties, you've got much less competition, in that most people won't be looking at those types of properties. So it enables you to look at the quirky things that other people aren't really getting into. So that's one big advantage, especially in this market. As Vanessa said, we're looking at high values for properties. It really is a seller's market in a lot of instances. So if you're pushing on the sort of top prices where you're looking at properties that are ready to go, this enables you to go in at a lower price point for a similar square footage of type or location of property. Where you can create an uplift in value, bridging enables you to realise that uplift really quickly. So what you can do is use the bridging finance to buy the property, and then you can refurbish the property. Where the property is then worth more money, you can then borrow typically 75% of that new value, and we can refinance that really quickly, which the aim of the game is to recycle that money in order to then be able to go and buy another property. So that's another great advantage. And lastly, you can complete more quickly, which in today's market I think is really, really important. Things are incredibly slow with most lenders at the moment. Some lenders are telling me that it's taking sort of 9 working days, for example, to get an agreement in principle from them, which is crazy slow. Solicitors are really slow. But with bridging finance, lenders use what's called title insurance, indemnity insurance. So you don't need most of your searches that you would do typically on a standard purchase. So you can complete quickly. It's kind of equivalent, slightly more, but equivalent to a cash purchase, although the lender does need some things, but much less legal requirements than a standard mortgage. So your conveyancing process is much quicker. I think at the moment, if you're sort of going back to looking at the types of properties that you're buying or potentially can buy, if you've got the ability to be able to complete quickly, there will be people in positions that want to move out quickly, and that definitely puts you at an advantage over most other people that will need a standard mortgage, especially people that are looking to buy properties for their own homes where you've potentially got chains. So yeah, bridging, I'm a big fan of bridging. I think it's fantastic. If it's used well, Obviously, it is more expensive than a standard mortgage, but all you need to do is work those costs in. If it doesn't work, it doesn't work, but work all the costs into what you're looking to do. And if it works, fantastic. Just before I start the next section, if anyone's got any questions as we go along, I'm more than happy to answer them at the end, as Vanessa said, so just put that in the chat box. If it's something that's a bit more specific about a particular property, then I'll talk to you about some options at the end as well, but generic ones for this evening, please. So the differences between bridging and mortgages. So we've looked at the advantages of bridging itself, but how does bridging differ from a standard mortgage? The big difference with this is that lending is not based on the rental potential of your property. So where you've got a standard mortgage or a buy-to-let mortgage, there will be a calculation that the lender will do to determine how much they can lend to you. So typically they will lend you 75% of the purchase price valuation, and the rental that you receive has to cover the mortgage payment by a certain percentage. So that's a minimum of 125%, and it can go up to 160%, depends on the type of property and whether you're buying it in limited or personal loans. But it's a percentage to make sure that you've covered that. If, for example, your property isn't in great condition, often the rental figure that the valuer will give is a lot less than what you need. And I've seen this a lot where clients will say they're trying to buy property with a buy-to-let mortgage, property's not in great condition, it's achieving really the lower end of what you'd expect to get in the location for that type of property, and therefore we can't lend 75% of the purchase price. The advantage of bridging is that it doesn't matter about that. All that you need to do is make sure that you've got a good exit in place to come off of that bridge. So you're looking at afterworks. So say your rental in its current condition is, I don't know, $750, for example, but it's in a great location, and as Vanessa said, you know, top end prices for 2 up, 2 down, we're looking at $950. So you've got potentially room to increase your rental by £200 a month, and that may well be enough to get you from, I don't know, 50% up to 75%. So you use the bridging finance to buy the property, we'll lend you 75% of the purchase price, and then as long as the rental fits with the new value once post works and the new rental post works, then it works, it fits. Once you finish your works, you then move on to your mortgage. So that's, I think, the big thing that gets missed sometimes. As I mentioned previously, it does not need to be in mortgageable condition. So it can have a roof falling in, a missing kitchen, missing bathrooms, you could have damp problems, you can have subsidence, all these sort of problems that you've got with the property, which would mean that you wouldn't be able to get a standard mortgage. You can get bridging. There are some caveats to that. Depending on the types of works that you're looking to do, you may need some experience. So where we'd class it as a heavy refurbishment, which is anything that needs planning or building regulations, usually you will need to have done something similar previously. But if it doesn't, then, you know, as long as you've got a builder, cost of works schedule, and it all adds up and makes sense, then that is absolutely fine. So again, that opens up on the types of properties that you can look at. And you can borrow the refurbishment costs. So we can talk about this if you'd like to, with, you know, with specific examples, because it does depend on the purchase price and your end value and how much your costs are as to whether it really works out. But there is a potential there to borrow the refurbishment costs. So you could have money towards the purchase of the property plus all the refurbishment costs. So that means that you're putting a lot less into your deal. And you don't need to pay it monthly. So if you've got a vacant property that you are doing works to, you haven't got the cash flow to pay that monthly, then the interest can be worked into that loan. That does mean that you end up most of the time with less on day one. So you may end up with, say, 70% instead of 75%. But it does mean from a cash flow point of view, you know exactly where you stand, nothing to pay whilst you refurb your property. So again, big advantages of using bridging for the right property. So we're going to move on to joint ventures. So joint ventures, there's different ways that you can set up a joint venture with people. The point of joint ventures is to reduce your risk, I suppose, if you're going in with other people into a property, and to increase the amount of cash that you've got. So it may be that you are time rich, cash poor, and you can work with other investors that are, the other way around. They're cash rich but time poor. So that's a good combination of people to work together. So there's different ways that you can set this up. What we see most of the time, I would say, is where people use investor funds. So we call it investor funds or angel funds. And this is where you've got someone who lends you an amount of money for a fixed return over a fixed period. And then it's up to you what you do with that money. And as long as you're able to repay that loan within the period of time that you've set, they walk away. There's no charges on the property. There's no sort of long-term relationship that you've got with that person. So it's a nice, easy way to learn how people work. So you can gauge how nervous that person is. If they give you some money and say they want it back in 6 months, do they genuinely? Some people say that and actually they want it back quicker. If they lend it to you for 6 months, could they then extend it to 12 months? And you can sort of gauge that relationship, how that person works, how confident they are in you. You could start with a small amount of money and then build up, just to build that relationship. That's a nice, easy way of doing things. Lenders are absolutely fine with that. It is a bit of a balance between your experience and the money that you're putting into the deal. Obviously, the lender wants to make sure they've got the right person on the application. So the more experienced you are, the happier they are about you using less of your cash. But on the whole, absolutely fine. We just need the loan agreement in place. That's absolutely fine. The other way of doing things is a joint venture. So a joint venture is where you would set up a limited company with yourself, your business partner, and someone else that you're going into a joint venture with. And you would set up that limited company together. So you can change your shareholdings and whoever's directorship as to reflect who's going to be having the day-to-day running of the business, who's putting what money into the business behind the scenes, so that shareholding can reflect that. And yeah, that's how that works, really. The considerations, I would say, firstly, your long-term relationship. So from experience of seeing clients use these sorts of things, what I would say is that you do need to really understand people before you go into business with them. And something I would suggest is, if you're able to, is to use someone, or just use their cash if they're able to, and it be your company that they're investing in. And do that first. Borrow some money, do what you say that you're going to do, pay back that money, and see how that works as a relationship before you start getting into business with somebody. Because people say things that they don't necessarily mean. They might say things in good faith, and that's how they feel at that time. But things do change, and if they're putting in, large sums of money, things might happen in the background, that are within their control or not. Financial situations change, and you just don't know how that's all going to play out if it doesn't go to plan. And it's always when it doesn't go to plan that all these things come out in the wash. It all goes to plan, it's happy days, but there are lots of things that could potentially go wrong, and it's how people manage those relationships. So I would say be very careful about who you get into business with, and making sure that you understand that before you do. You need to be really clear about how you're going to pay them back, and you need to have a really clear plan. So if, for example, you're just buying a property that's just going to be let out, standard buy to let, doesn't need anything doing to it, you're going to give it to Vanessa and she's going to let it out for you. How's that money going to be paid back? Is that an amount each month that gets paid back? Because if it's a large sum of money, potentially that could take an awfully long time to pay that back. Where we see it working well is where you're buying property to refurbish or to convert and then refinance, and where you ideally are making the money back quickly. So you will then leave your money in the deal, but you'll be able to then pay back your joint venture partner. And the advantages of using limited companies with these sorts of things is that you can then change the shareholding and who the directors are of the company at a later stage. Just need to be careful about mortgages. Ideally, you want to do that at the point of remortgage, because otherwise you've got people on a company that aren't on mortgage, or vice versa. But it can work well as long as you've got a clear plan. And thirdly, do your due diligence. You will be taking out a mortgage albeit in a company with these people, but you will still be forming a financial relationship with people. So make sure that you know everything that you possibly can do. I would ask for credit searches. Companies' house checks are great, it's all public information. Credit searches obviously aren't, and I'll be really, really clear. Credit searches on partners, that's something that crops up every now and again. For example, I had a client who we were trying to put mortgage with one lender, and his wife had taken out an unsecured loan with this lender and had missed some payments on it. And because of the financial link between him and his wife, they wouldn't lend to him. So he's in a joint venture situation with 4 people, and all of those people have then been affected by his wife not paying that loan. And then once you've applied to a lender and they've said no to you, the chances are that they're not going to then lend to you in the future. So you do need to be really, really careful about who you're doing business with. I think credit searches for everyone, spouses, are really, really important. So how can this help you accelerate your growth? So it's cash available. I mean, in an ideal situation, you will be buying property and recycling it and putting it back into property again. But at some point, that is going to run out. So using joint ventures is a great way to allow yourself access to more funds, hopefully to recycle and put back into more deals. And if you can build long-term relationships with people who have got this cash and haven't got the time to do the investments themselves, that's really key. Bank interest rates are incredibly low. Vanessa gave the example of 4.5% in Luton. Today I noticed you can get a 1-year fixed rate bond with a bank I spotted at 2.6. So even if you think, oh, 4% isn't great, it's an awful lot better than you're going to get if your money's sat in the bank account. And that's just yield based on buying one buy-to-let, isn't it? You start doing various different things, and it's going to be much higher yield, and you'll be able to pay your investors a much higher interest rate than they would be able to get at a bank. So that is joint ventures. Another way of raising capital is by refinancing your existing portfolio. So firstly, I just sort of want to explain a little bit about portfolio landlords. So as you start growing your portfolio, once you get to your 4th property purchase, lenders will class you as what's called a portfolio landlord. And what that means is that for every new application that you have with any bank, most banks, some of them are sort of take themselves out of that for various reasons that I won't go into tonight. But the majority of lenders will check your outside portfolio, and it's got to fit some stress tests. So they need to make sure that your whole portfolio is under 75% loan to value, and they have got to make sure that your rental covers your mortgage payments by an artificially high interest rate, and then a percentage on top of that, so 125% at that artificially high interest rate. So you do need to be careful about when you're refinancing your property, making sure that you're not making yourself unmortgageable further on down the line. So just bear that in mind. You can get buy-to-let mortgages at 80 and 85%. I think it's something you just need to be careful of. If you happen to have a property which is really low yielding in London, for example, and you can't get anywhere near 75% on that property because of the yield, if you've got another property that you could then borrow 85% against, but your overall portfolio is under 75%, then I can see how that would work. But in the majority of situations, I would say probably best to keep it under 75%. So you can have a look at the properties that you can refinance. As Vanessa said earlier on, like prices are high at the moment, and we are really seeing that reflected in refinance valuations. And for a long time throughout COVID, we weren't seeing great valuations on refinances. But at the moment, we're really seeing that, we are getting those top prices. And I think that's a reflection over the fact that we have had the last sort of 6 to 9 months of really high prices in property. So we've got good sold comparable data. So I would say at the moment, now is a really good time to refinance and to review your portfolio. Another thing I think it's worth looking at is if you're within a fixed rate period at the moment and you've got quite a low early repayment charge, is it worth fixing it in at the moment, bearing in mind that interest rates are probably on the up? Depends on your personal view. I mean, I wish I had a crystal ball to be able to see what was going to happen. Unfortunately, I don't. But if you think that interest rates are going to go up, then it's worth just sort of having a look. If you're paying 2% now, for example, if you're to come out and go into another 5-year fixed rate at a relatively low rate, do you think that's worth spreading that 2% over 5 years? It's a decision only you can make, but it's worth having a look at, I think. Also, bearing in mind that refinance valuations are so high, so when you come to refinance, if your early repayment charge finishes in a year, for example, do you think that we're going to be in a similar situation? Bearing in mind that we only use comparable data for the last 6 months for refinance valuations. If the next 6 months drop slightly, you may not be in as good a position to refinance in 6 months' time. But worth looking at the figures and seeing what they look like. And the other thing is, if you've got HMOs or blocks of flats within your portfolio, there are various different ways that we can value HMOs and blocks of flats. If you used sort of relatively standard lenders, the likes of Precise and LendInvest and those sorts of lenders, they will value blocks of flats, for example, on a block value. So what that means is if you've got 5 flats in a block, each flat's worth 200,000, the block is worth £1 million, you would then deduct roughly 10% from that figure, and that's the figure that they would use. Their theory is that if they were to offload that block as one, they would have to reduce the price roughly by 10% to be able to sell that block off to an investor versus selling it individually, which is how they would probably dispose of it if they had to repossess the property. So you're losing out on 10% of that value when you're mortgaging your property. There are lenders with blocks of flats of up to 10 flats where we can look at what's called the aggregate value, and that is literally adding up all the individual values and lending off that figure. As an example, I've had a block of flats in Margate in Kent, and he had it valued about a year ago on an aggregate value, and that came in at 825, and then we've just had it valued, block value, a year ago, and then we've just had it valued as an aggregate value for 955. So that explains the sort of the uplift. So if you have got a mortgage on a block of flats, which is based on the block value, which it probably would be, we could look to refinance to pull out some more money based on that. It does depend on a few things. The flats do need to be able to be split off and sold separately. So they need to be above 30 square metres, split utilities, split access. They don't need to be on individual leases, just need to be able to be split off on individual leases. Interest rates are slightly higher, but if you can pull out a decent amount of money, which then means that you can invest in another property, you're then balancing out that money. HMOs. You may have heard the term sort of a hybrid valuation or a commercial valuation on HMOs. That's something that we can look at. Generally for HMOs with sort of 5 or 6 bedrooms with all en suites or mostly all en suites. And then we can look at using the yield value, the rental yield, rather than bricks and mortar value of the HMO. That can create a good uplift in the value of your HMO, which again means that you can pull out some more money and then invest somewhere else. Again, interest rates are a little bit higher, but if it allows you to to buy more property and increase your income, then it's something that might be worth it. So have a look at that. So next we're going to talk about sort of limited company versus personal mortgages. This is something that again comes up a lot. I think there's been a lot of changes over the last couple of years. Section 24 tax changes that came in, about 6-7 years ago now, and over the last sort of year or two, we're really seeing that landlords are being affected by this. So if you own property in your personal name, you are taxed differently, taxed on your turnover effectively rather than your profit. Whereas if you've got property in a limited company, you're only taxed on your profit. The other thing is you're only taxed on what you take out of your company. So a big advantage, which I don't think is spoken about enough, is that if you've got a limited company, you don't take any money out of that limited company, you keep it within that company and then use that money to buy more property, you're not taking it out. So therefore you're not taking an income. So therefore no tax to pay. So it's more than just the main difference, as I say here, is the tax that you pay. And that can be a big difference. So it's definitely worth speaking to your accountant. And there are sort of bigger implications in terms of capital gains and corporation tax. It's definitely really important to speak to your accountant. But there are loads of other advantages of having a limited company other than that. So as I said, keeping the money within the company and using that, sort of recycling that money within the company that you're not taking out as income. You can loan money. So if you've got a limited company for a separate limited company for you're self-employed, for example, and then you have a property company, as long as the director and shareholdings are similar, you can then loan money from one company into another company. And as long as you pay that money back within 12 months, again, there's no tax to pay. So you can offset cash that you've got in other companies and use it to buy property. Again, speak to your accountant, not tax advisor. Check out all these things, but I think there's ways that you can structure your company that's just a little bit different. So it's definitely worth speaking to your accountant about how it all works. In terms of how the mortgages differ, if you are a first-time landlord and you're buying a standard buy-to-let property, there are plenty of high street lenders out there offering super cheap rates for personal mortgages. So there is a difference in terms of the interest rate if you are buying your first or second buy-to-let property. If you start being anything other than that really standard buy-to-let property, or you're starting to become a portfolio landlord, or your income is a bit quirky, maybe you haven't been self-employed for long enough, or you're a full-time landlord who has done lots of refurbishments in the last couple of years, and so your income on your SA302 is low, or for a whole host of reasons, if you fall into kind of the more specialist area of buy-to-let, at that point there's no difference really in interest rate between personal name and limited company. When you get into HMOs, blocks of flats, commercial, semi-commercial, bridging finance, all that sort of thing, it's exactly the same. There's no differentiation in terms of interest rate. The way the mortgages are set up is slightly different. So in a personal name, you sign as you, and you are personally liable for that mortgage. As a company, you would sign as the director and shareholder. And then you would also sign what's called a personal guarantee. So what you're saying is that if the company's unable to make the mortgage payments, then you would then be liable for those mortgage payments instead. The reason is because the share capital that you need to put into a company in the UK is £100. So if the company went under, the mortgage lender is trying to repossess the property, there's not going to be any cash in that company. So there was a few cases a few years ago where some banks lost a huge amount of money. So just it's not worth them lending without a personal guarantee. You will always have to sign a personal guarantee. There are some lenders that will allow you to drop that in terms of sort of percentage, that might be 25% of the loan, but on the whole, generally 100%. Some lenders will put what's called a debenture on your company, and it's just extra security for them. But yeah, we can see some more information on that. I can let you know. But it's fairly straightforward both ways. I've done this in the wrong order. We've talked about a limited company as a separate entity. But again, yeah, talk to your accountant, because hopefully you've got a good accountant, and if they are specialise in property and tax advice, and they can give you some more creative ways of dealing with things. My job, I guess, is to find the solution once you've been told how to do it. But as long as you go to the right lender, you will find a lender that's absolutely fine with it. Most sort of high street lenders aren't going to be okay with intercompany loans and directors' loans and all those sorts of things. But you probably will find that paying a slightly higher interest rate that allows you to do all of those quirky things will leave you better off financially than not. So again, we can work it out, but that's something to think about. We've spoken about personal guarantees and debentures as well. I don't know what the wrong order to say, but I hope that's useful. If you want any more information about all these sorts of things, then Vanessa will cover off about the mastermind at the end. But yeah, that's sort of something we can go into in a little bit more detail. So lastly, HMOs and multi-unit freehold blocks. I've touched on this on the refinance part, but I think this is something. I think once you've started buying a couple of buy-to-lets, and you can see how the model works, and you kind of get a bit of a feel for it, get a bit of a bug being in this property world. There are loads of other things that you can do to create more cash. I'm not sure this is the one that's going to help you with this elusive passive income. I don't think HMOs or multi-unit freehold blocks are going to help you out there, but they do tend to give you a higher yield. So I'm sure Vanessa would kind of give us some ideas about the yield that you'd get on flats or HMOs versus houses. I would imagine that you're probably looking at, I don't know, maybe 6-7% versus probably 4 or 5. Getting a nod, that's good. In Luton, and it works in other places as well, because with HMOs you're letting it out to 4, 3 or more tenants within that property. You're sharing utilities and bits and pieces, so the money you're getting in each month is much higher than on a professional, on a family let. Once you've got a couple of buy-to-lets under your belt, that might be something that you want to look into. And again, I mean, you do need an HMO mortgage on an HMO. You can't get an HMO mortgage on a property that's not in a licensable condition. So if you're looking to buy property to convert them into HMOs, you'll need to use bridging finance. Again, this is something we can talk about in a little bit more detail at another time, if you'd like to, about how all of this works. Multi-unit freehold blocks are a great way into these sorts of things. You haven't got the dramas of paying bills for your tenants. People are in separate flats, so you haven't got that communal living that can sometimes cause tension. But you can buy low value flats within a block, and you haven't got the minimum loan size that you would do on one single unit. So most of the time, lenders have a minimum value of 75,000. If it's within a block, that doesn't really exist. You could have flats worth 30,000 each, for example, put them all together, we can lend against the block. So it opens up far more possibilities, and opens up more higher yielding types of properties. There's also things we can do, as I mentioned before, about valuations, which is a great way to make some money. If you're buying property, refurbishing it, refinancing it, you can often refinance at a much higher figure than what you bought it for. So it gives you an opportunity to recycle cash easier. And standard properties as well. And that brings me to the end. So as Vanessa mentioned, we're really active on social media as well, so please do give us a follow. I do lots on Instagram and LinkedIn particularly. We do videos, little snippets of information, blogs each week, which will hopefully give you lots of added value and help you along your way. So yeah, please give us a follow. And these are my contact details if you need anything else. That's me done.
Brilliant. Thanks, Ellie. Thank you very much. Yeah, lots of information. No, that was all good. Lots of information. Obviously, on a Zoom call like this, it's very difficult to cover everything in detail because there is so much to say. So it was more to give you guys an overview, to trigger some ideas, trigger some new concepts that you may not be aware of. Hence the reason why I said at the beginning of the call that we will host a mastermind group for a maximum of 10 people. If you look out in the chat now, a link will be dropped in the chat where you just literally click in that link if you'd like to attend a mastermind group with myself and Ellie, where we'll be able to go into specific strategies lot more detail, especially if you've got something in mind or you've got some money that you're looking to invest, but you're not quite sure which way to go, the mastermind would be perfect for you. Just literally click the link, and that will allow you to kind of attend the mastermind. There's only space for 10. That way we can kind of answer everybody's questions and deal with things in a lot more depth. So first come, first serve. If you'd like to do that, I think there should be a link appearing for you now. Just to finish off, for the last, we're sort of running almost to time. So we've got about 8 minutes or so for some Q&A. Whilst Ellie was speaking, there were a number of questions that were coming up in the chat box. So what I will do is pick out a few. I will try to focus on the ones that I feel that the majority of us will benefit from, for either Ellie or myself to answer. So I'm just literally flicking through the chat box now. I have a question here that says, you said you can refinance quickly, but don't you typically have to own the property for 6 months before you can get a standard mortgage? I think that's a good one to answer, Ellie, because people are always unsure when they buy a property that they've bought hopefully below market value to refurb and recycle. How quickly can we do that transaction to flip it over?
Well, it's a great question. There are plenty of lenders that don't need you to wait 6 months. I think the biggest issue that we're having at the moment is land registry. Land registry are really behind on registrations, but once we have an offer for the mortgage, the term mortgage, we can expedite it with land registry, which typically then happens within 10 days. But yeah, we can. Simple answer. Yeah, there are plenty, as long as you look in the right places.
Okay, so it's not a golden rule, because I think there's there's a myth out there that says 6 months is the golden rule before you can flip. Okay.
Some lenders do. You know, there are plenty of lenders that won't allow you to refinance within 6 months, but equally there are plenty of lenders that don't have
okay, brilliant. We have another question here that says, so bridging loans are for properties that normal lenders won't lend on and give you the funds for quickly. Is that the case? Is that
basically, yeah. I mean, there are a few reasons why you'd use bridging. I mean, auction purchases for one, so you might have a property that's in perfectly good condition, but if you need to complete it in 28 days, you're going to need a bridge to do that. But on the whole, properties that standard lenders won't lend on.
Okay, and I think following on from that question, there's a question here which I think is quite interesting. It says, so if you don't have to pay your bridging loan back monthly, does that mean that you could pay the bridging loan back when you flipped and sold the property? So essentially you borrow the money, include the refurbishment costs, do the refurb, and then pay it back when you've sold it.
That's exactly it. Yeah, it works differently for different types of bridging loans. Typically your loan will be sort of 75% gross. If you're not paying a bridge monthly, then that money comes off. And I can go into a bit of detail if you've got an example. It's a bit easier. But yeah, the interest will come off, and you can decide how long you want that interest off for. So, for example, if you think that your refurbishment's going to take 4 months, you think your tenant's going to be in within 6 months, we could what we call retain 6 months interest. So there's no interest to pay for 6 months. That amount comes off the loan, and then at month 6, ideally you've got a tenant in the property, even if you haven't refinanced, and that tenant would pay for the majority of, if not all, of your bridging loan. We can work out figures. If you're borrowing for the refurbishment costs as well, there are lenders that will allow the interest to be rolled up on top of and sort of taken into account with the end value. So you end up with kind of normally 70% on day one, plus all the refurbishment costs. And then, yes, you pay it back on sale or on refinance.
Sounds very it sounds like a very exciting option for people. Essentially, you're building your property portfolio on other people's money, which is
exactly.
I mean, obviously there are disclaimers here, and you really do have to do your homework and your due diligence. So obviously we're talking about best case scenarios, so we do have to obviously fact find first. A good question here about bridging loans is the interest rate. What sort of interest rates, Ellie, are bridging loans charged at?
I'd say be careful on this, because there are loads of lenders out there that will say that they'll charge you a really low interest rate, and then they'll kind of add fees on everywhere else. We're really careful about the lenders that we use. I like lenders that are really upfront, do as they say. But I would say roughly sort of 10% a year, I would say. Stick with that and you won't be far wrong. You might be able to get something a bit cheaper. Depends on the work that you're doing.
Okay. I'm just having a look if there's any other general questions. Somebody says, where does one look to find MUFBs? Vanessa, they're asking me that question. Okay.
Yeah.
I think what we're seeing now, those are the Ellie, can you just explain what MUFBs are again so that everybody knows?
So it stands for a multi-unit freehold block. So they are a block of flats which would be on one freehold. So a lot of the time you see it where you've got like houses that have been converted into flats. So Victorian terrace properties, for example, are a great example of often where you'll have like ground floor first, second, or lower ground first floor that have been split off into flats, rented out separately, but stay on one freehold title.
I think where you can find them, I think it's just the same as all the usual avenues. You're going to be looking with us, estate agencies, you're going to be looking on auction. What we're seeing now is a lot of the retiring type landlords who are moving towards a different life cycle for their property, for them in property. They may be selling up. If they've got units like that, they are looking to sell up. We're seeing loads of those sort of landlords come forward now to sell, mainly driven by all the changes in the legislation for landlords. It's just the law just keeps getting quite tight, quite hard on landlords. So we find that the more mature landlords who may have had their properties 25, 35 years or so, they're of retirement type age, they are selling those kind of units, or they are selling a number of single units that they own. So yeah, it's just about being creative with your property search, really, to find those sort of opportunities. Where's the link? The link's in the chat. So a few people have said they can't find the link. It's in the chat. We'll probably repost it, but it's definitely there. I can see it for the Mastermind Group. Ellie, what are the lending options on land? We have an investor asking.
Land is tricky at the moment. Lenders are really tightening up what they are willing to lend on because profit is really being squeezed. The base rate's gone up. What we call the swap rate, which is the rate that wholesale funding relies on, rather than the equivalent of the base rate, is now up to 3%. So that's a huge increase and much more expensive than the base rate. So where you've got bridging lenders and more commercial lenders that are relying on wholesale funds, they are much more expensive. So they're really squeezing what they're able to lend on. Land, if your land is worth more than about 750,000, I can do something on that. If it's worth less than that, then you're going to struggle. But typically land, if it's not got planning, then that is a bit of an issue. If you've got land with planning, or you've got an option to buy it with planning, or you're going to apply for planning whilst the bridging loan's going through or something like that, so that when you buy it, it has planning. We can do that, probably 60-65% loan to value, the value of the land. But yeah, land is a problem at the moment.
And just one last question. I think if I've got this question right, I'm not sure if I've read it correctly, but it says, with the affordability calculator being scrapped, are 10% buy-to-let mortgages still available?
So the affordability that's being removed is to do with residential mortgages, and that's to do with the additional checks that lenders have had to do over the last few years to stress your mortgage payment. So no, it's not. It won't affect buy-to-let mortgages at all. So a simple calculation: if you're buying a standard buy-to-let property in a limited company, what you need to do is assume that your mortgage payment, mortgage interest rate, is at 5.5%, and then work out what your mortgage payment would be per month on interest only, and then times that by 125%, and that's what your rent needs to be. But it would always be, there are some 80 and 85% mortgages out there for buy-to-let. They are much more expensive than at 75%, like a whole percent more than at 75%, because it is more risky. But yeah, I don't think we'll see 90% buy-to-lets, personally. I was at Northern Rock in 2007 selling 125% mortgages and then dealing with queues of people when it all went horribly wrong. So personally, I don't think it's a good idea. I think we need to keep that buffer.
Agreed. I think that's the last question that we'll take. I think we've covered pretty much most of the questions, and we're literally just over an hour into the call, which is perfect timing. So like I said, there is the link in the chat box if you're interested in the Mastermind Group call for 10 people only. It's been an absolute pleasure having everybody this evening. Thank you very much to Ellie, our property finance expert, for being the guest speaker tonight.
Thank you, Vanessa, for inviting me.
This is something that we love to do at VA. We're all about trying to bring cutting edge information, keeping you guys up to date on landlord movements, buy-to-let movements, so that you know what's going on, and we put you at the front of the market as best as we can. Hopefully in the next 3 to 4 months, we will have another VA expert webinar that will be based in the legal domain. And we have a solicitor that we're currently talking to about that one. Once we're ready with the content and the agenda, we'll start to promote that. But yeah, if you've got any questions, if you've got a property that you're not sure what to do with, whether it's on the sales side or the rental side, if you have a tenant and you have a tenancy problem, VA are always at your hands. Please do give us a call. Like I said, follow us on social media, Instagram, Facebook, LinkedIn. Yeah, and it's been a pleasure having you guys tonight. Thank you for giving us an hour of your evening. I hope you've been able to take away a few golden nuggets of information from tonight. And we look forward to seeing you guys in a few months' time, if relevant, for the next expert webinar. Thank you and good night.